Good morning, ladies and gentlemen. Thank you for joining us this morning. My name is Richard Hayes. I'm the head of working capital at Nordea. And today we'll be discussing the findings of Nordea's latest working capital report, which will be published later this morning. I'm delighted to be joined this morning by some of my colleagues from Nordea's working capital advisory team, who will take us through some of the key findings of the report and highlight areas where we can potentially focus to improve an organisation's working capital, and also look at the impacts of the ongoing COVID-19 pandemic. There'll be time at the end of the discussion for questions, so if you do have anything you'd like to ask, please send that to us in the chat and we'll pick it up and raise it with the panelists at the end. So let's get started, and I'll ask my colleagues to introduce themselves to you. So Vanessa, can you start, please?
Yes, good morning, Richard. Good morning, everyone. My name is Vanessa Komorowski. I'm working in the Working Capital Advisory team, where, as the name suggests, we advise our customers on both trade finance and working capital solution. We also look at the latest trends and insights from global trade, and we produce material and reports for everyone who's interested in treasury and trade-related matters, as is the case of the working capital report that we are going to discuss today.
Mathias?
Thank you. Good morning, everyone. My name is Mathias. I have been working in trade and working capital advisory since 2018, conducting trade and working capital related analysis and reports, as Vanessa mentioned. Prior to my position in trade and working capital advisory, I worked with trade finance and export finance.
And lastly, Henrik.
And not least, I hope. Yeah, my name is Henrik Anbelin. Under normal circumstances, I live in Sweden, work from Denmark, and meet up with clients from the Nordics. But as you know, during the COVID-19, I'm pretty much stuck here in Sweden, which is not bad all the time. But this is the fourth time that we conduct this study. Normally we look into 4 years of development, but during our when we started to do this study, we of course hit into the corona pandemic, and so we have also looked into the half year of 2020.
Okay. Excellent. Thank you. So let's get started. I mean, we've obviously published, or we're publishing the report this morning, and it'll be interesting just to pick out some of the key highlights from the investigation and what's history shown us. Henrik, maybe let's start with you then. I mean, what have some of the headlines trends been in regards to return and working capital that we've picked up within the report?
Yes, yeah, the sample covers 9,300 global publicly traded companies over 20 industries. And on an aggregated level, we see a sharp drop in return between 16 and 19. And the return we measure as return on capital employed. And it has dropped with 1.3 percentage points from 19 to 16. And this might not seem to be a high decrease, but notice that we talk about percentage points. And as in 16, the return stood at 8%, and in 2019 it was at 6.8%, with a significant drop in 2019. The main reason for the decreased return is the operating margin. But as to working capital, we see that companies has actually been able to somewhat improve their working capital, and this has mitigated the decrease in return, which would otherwise have been even larger. As I mentioned, this is a large sample of companies, 9,300, and of course not all companies and industries have performed worse. And what we have done this in this report is to sort of look into why some companies has been able to improve working capital while others have worsened it. And as we proceed in the report and today, I think we will elaborate a bit further on this. And we try to sort of understand which companies that has performed better than others and why this is. We will also look at which companies that have been able to continuously perform better, and also on the link between working capital and return on capital employed.
Okay, interesting. I think, Mathias, maybe come to you with the next question then. I mean, as Henrik said, some companies have performed well, some companies less so. What strategies have companies been focusing on during the period that you've been looking at in the report?
Yes, first, overall, it seems that companies are still more focused on their profit and loss rather than they are focused on their balance sheet. And as Henrik mentioned, we have seen sales increasing and we have seen margins and returns decreasing. And this could indicate that sales is the most important KPI. And it's really important because we have seen examples from this, and it is really important that both procurement and sales teams and treasury, they agree on what the strategy should be, because you can have a procurement department that would like to source cheap, and maybe they do that by paying faster. And then you have a sales team that's very focused on increasing your sales numbers, and maybe they do that by offering favorable payment terms toward new customers. But then on the other side of the table, you have a treasury department that's very much focused on the balance sheet. And here you end up with 3 different strategies within the same company. And then it's very difficult to optimize your working capital. In terms of the working capital and the strategy for these companies we have analyzed, it seems to be that companies have been much more focused on their trade payables and to extend payment terms towards suppliers rather than they have been focused on their trade receivables, handling them efficiently and on time.
Okay, thanks. And Vanessa, let's just maybe pick up on that point a little bit more. Again, Mathias and both Henrik have said that some companies have been performing well and others less so. What have the best performing companies been doing then in regards to their working capital? And sort of conversely, what have the worst companies not been doing?
Yeah, as Henrik mentioned before, we looked at this report specifically on what best versus worst performer did and which strategies they applied in terms of working capital, especially because we see a direct relationship between returns and working capital. And in fact, when we looked at the top 25% of the companies with the lowest net working capital over sales ratio, and we compared them with the bottom 25%, so with the highest working capital over sales ratio, we could see the difference in terms of returns, with the first one generating on average 13% versus only 1% for the worst performers. Same goes for leverage. We saw that the best performers operated at a negative net debt over EBITDA on average. And so we see these 2 direct relationships between working capital returns and leverage. So we wanted to understand and identify the successful strategies that maybe these best performers applied. And the findings were pretty interesting because, as Mathias said, we saw that companies tend to focus on improving the days payables outstanding, so their payment terms towards the suppliers. But when we look at the top performers of our sample, we actually see that the trend is reversed. So the best performers, this top 25% of our sample, focused on the customer side more, so receivable collections, and 70% of them improved the days sales outstanding. It's also worth mentioning that all the companies in the best group improved at least one of the working capital components, and almost 20% of them improved all the working capital components, so on the inventory level, receivables and payables. And this actually shows that they have managed actively working capital, and that probably working capital is part of their strategic agenda and they have been working on it. We also consider whether size is a key factor for a successful working capital optimization. And we actually found out that it is not the most relevant, at least, factor, because small companies are also able to maintain low levels of working capital over sales as long as they improve every year, although maybe they don't have the same strong bargaining power of large companies. but they might be even more willing to do so because smaller companies might have lower ratings and thus higher interest rates, and maybe it's more expensive for them to finance the gap of working capital and the cash tied up in working capital. Of course, every company operates with its own unique business model, so there's no perfect strategy that fits them all. But at looking at least by looking at the best performance, we see the benefits of having a strategic approach towards working capital.
Sure. Okay, thank you. I mean, 2020 obviously has been very difficult for both companies and obviously for society at large. And it's interesting, I think, if we drill down into exactly what the impact has been from a working capital perspective. Here, I mean, Mathias, maybe let's have a look. I mean, given the turbulence of 2020 and how the pandemic's been evolving, what has the impact been that you have seen in the report on working capital?
First, in the beginning of 2020, we saw the global container throughput went down 20%, and the number of new export orders went down 40%. So 2020 has been a very turbulent year, and hopefully we start to look into a more normal 2021 with vaccines on its way, and we also see the GDP for most of the Nordic countries are growing in the third quarter. And the pandemic has affected most companies, and if it hasn't been in terms of sales decreasing, then at least in terms of people having to work from home and processes being disrupted. But when we dig into how the pandemic has impacted the working capital levels, we can see that it has impacted the levels in like two stages, because in the beginning of the pandemic, I guess we were all unsure on how serious this was and maybe whether it would actually trigger a new financial crisis. We saw most countries, they literally shut down in the beginning of the pandemic, and we see especially sales decreasing as most companies were on hold waiting to see how much this would impact their industry and the demand after their goods. And for those companies, we have seen trade receivables decreasing, obviously as sales decreasing. But from here, it actually differs from industry to industry, because some industries have seen a rise in demand after their goods, and many of them have been forced to use their inventory as the supply chain was almost disconnected, especially for companies sourcing in Asia. And for these companies, we see a very low level of inventory. But on the other side, we have some industries that experienced almost a zero in demand in the beginning of the pandemic, and that forced them to sit on their inventory, and maybe even worse if they have large orders coming in that they couldn't get out of. So that's two scenarios based on which industry you are in and the demand after your goods. But overall, on an average level, we see the trade receivables have decreased due to the decrease in sales, and the inventory level is steady. And under more normal circumstances, maybe you could say that this is a sign of a recession, but now we see that the trading volumes are starting to catching up, and we also see the GDP in Denmark, Sweden, and Norway are growing with almost 5% here in the third quarter. So hopefully we're getting back to more normal levels now.
Okay, interesting, thanks. And Vanessa, I mean, maybe if we take a more macro view, obviously Mathias just said there that it's some of the impacts have been industry specific, but if we take a more macro view a little bit on focus on the Nordics, how have the Nordic economies been and corporates been performing relative to their peers in the rest of Europe?
Yes, of course, there are some differences among the Nordic countries. But if we take the Nordics as a region, we can say that the Nordics as a region has found itself in a relatively favorable position compared to other countries and regions in Europe. We know that the Nordic welfare states and that all the additional fiscal measures that the governments put in place have helped mitigate some of the long-term effects of the pandemic. Of course, as Mathias said, the impact has been severe, but we know that it has been less bad compared to other regions in Europe. And as Mathias said, this can also be seen in the expected economic contraction of the Nordic countries compared to maybe what other European countries are expected to suffer in terms, for example, of GDP. And not only actually the impact has been milder, if we can say so, but also the Nordic countries are expected to recover faster. And all this is thanks to not only this fiscal stimulus that I was mentioning before, but also to maybe less reliance on some of the industries that were badly hit by the pandemic, like tourism or heavy industry. Also thanks to the strong digital culture that characterizes the Nordics, and that, for example, allowed for fast adaptation to work remotely during the lockdowns. If we then maybe take the trade finance perspective a bit farther, we also need maybe to mention that the Nordic countries rely on export, and thus we might not have yet seen the full impact of the pandemic, actually, because when we looked at some of the large manufacturing companies in the Nordics, we could see that large pre-orders made in 2019 or previously actually have kept also the business running, and maybe the sales a bit more stable than what it would have been without those pre-orders. And when we looked at the order books this year, we saw fewer and fewer orders. So perhaps the impact on cash flow and sales has yet to come, and we will see something more in 2021. However, I think that also from a trade perspective, we could say that the Nordic region has found itself in a good position. That's due to sector composition, for example, as I mentioned before, and as Mathias briefly mentioned, and also for the fact that Nordic countries mostly export to the Nordic region and not the Nordic countries like Germany or in North Europe, which have all kind of maneuver through the pandemic in a good way. So the impacts also on export levels have been perhaps less bad than other countries exporting to other regions of the world, also outside Europe, that were affected more.
Okay, thanks. And Henrik, I mean, maybe just picking up there a little bit on both what Mathias and Vanessa were mentioning. We said that certainly the impact's been felt differently in different sectors. What have the observations from a report been in that regards? And have any sectors really sort of had a good pandemic? Have they actually seen sort of a positive impact on their working capital during the pandemic?
Yeah, I think, as you said there, Richard, I think Mathias and Vanessa covered most of it there. And I think everybody here on the call knows that some industries have been impacted severely, and others have actually, gained from this pandemic. As to working capital, it is clear that, for example, manufacturing companies had a lot of headache, covering both, supply and demand. And Vanessa, I think she said it quite well there, talking about, if you have been looking for supplies from Asia, it was a problem in the beginning when China was the first country to lock down. But then, of course, when China opened up so quickly as they did, I think that sort of made, the recovery easier for companies here in the Nordics. Your question there, Richard, was about, has somebody done it better than others? And
yeah.
I think we can notice there that, those companies doing it well before the pandemics. I think we have been talking about companies that has a long-term focus on working capital. We can see and notice that they actually, this works in a situation as the pandemic has sort of put us in. And they are actually, doing better during the pandemics as well. So, what we would say is that, companies with focus on working capital and having a clear strategy, and if they follow it, they will also, have a better result during, stressed situations.
Okay. Thanks. And maybe, Mathias, we come back to you. we've sort of understood through the discussion so far that there's been obviously a significant impact on working capital and the companies that we've studied in this report as a result of a pandemic, and some sectors have done better than others, etc. But I mean, when you've done the report and the analysis, how do corporate balance sheets look right now? Is there examples for of increased or noticeably higher leverage, for example?
Yeah, it's not only sales that have been impacted, and when sales starts to decrease, it's affecting your company's value creation. And when we look at the corporate's balance sheets, we see that for most companies, the interest-bearing debt have increased quite significantly. And it's actually a chain of events that leads to this, because when your sales starts to decrease, this follows a steady level of working capital that you have to finance somehow, because you still have your inventory and you still have your suppliers to pay, and you still have all your other fixed costs. And normally you would use your cash flow coming from the sales to finance this, but with no sales, you have to look at other options. And according to our study, we can see that, and especially for Nordic companies, they have obtained short-term debt in order to finance the daily operation. And this has led to an increase in leverage measured as net debt EBITDA. And we see that for the second quarter of 2019, the average net debt EBITDA in the Nordics were 1.8 times. And here in the second quarter of 2020, it has risen to 2.25 times. We of course need to look at the EBITDA level as well in order to conclude something from the leverage. And here we see that the average level of EBITDA has decreased with 8% in the Nordics compared to the second quarter last year. So it's a mix of lower EBITDA results and higher amounts of net debt that has led to this increase in leverage. But we still see the higher amount of net debt as the value driver for this. And the problem that many companies can run into is that we think that sales, they will catch up quite fast, and we already see trading volumes catching up here in the third quarter. However, it is taking more time, and it's more costly to service your debt obligations. And depending on how much debt your company have had to obtain during the lockdown, it can take some time to recover from this. And when you have to service your debt, there is obviously less cash available to support both strategic and financial initiatives. And that's also why we would like to emphasize the importance of working capital management and the link to value creation, and especially now when you are seeing higher leverage levels in the Nordics.
Yeah, thanks. I mean, we've obviously spent a bit of time here recapping what we found in the report and obviously the impacts in 2020 compared to 2019. But I think maybe we should look further afield and further in front now into the future, and what companies can do to improve their working capital, as you say, Mathias, but also looking at that important value creation aspect of it. So, I mean, maybe let's start on the economic signs first, Henrik. I mean, what are they? What are the future economic signs right now in terms of recovery?
Yes, last week OECD came with its economic outlook for in December for 2020. And the world GDP has sort of decreased a lot. We all know that. It is estimated to decrease with 4.2% in 2020. And giving a picture of that is that these 4.2% in decrease, it's the amount of Germany's and France's GDP put together. So it's a massive decrease, of course. But OECD anticipates a gradual recovery in 2021. But the estimate of this recovery is, of course, leaning a lot on the vaccine and how effective this is. And looking further ahead, they believe that in the fourth quarter of 2021 that the GDP will be at the same level as the world GDP was in 2019, the end of 2019. And of course, value creation and working capital is very much correlated to the world economy and on the trade. And two things that we want to highlight is firstly, we think it will be still hard to estimate demand going forward for each industry and company. And how much do companies need to purchase going forward in order to satisfy demand? And I think this will be one of the things that companies will think a lot about, not to order too much, which there will not be demand for, or the opposite, order less and not having enough for the demand. Secondly, if demand takes off, what we have discussed before also is that are the companies financially fit to grab the opportunities? And as Mathias mentioned, a lot of companies have increased their leverage, and if they are not as financially fit as they were before the COVID-19, will they be able to grab the opportunities that lies ahead if we see sunnier weather?
Okay.
So, yeah.
Okay. I mean, let's maybe focus on some of those levers then that we sort of have hinted at in the early discussion. Vanessa, I'll come to you then first. Supply chain financing is something that I know certainly when we talk to customers, there's lots of customers are focused on it. It's a growth area certainly within treasuries at the moment. But viewing that and working capital in the context of coronavirus and COVID-19, how do you view DPOs at the moment, and is the scope there to push them out and extend them any further as a result of the COVID-19 situation?
Yeah, that's an interesting discussion on like what to expect next and how will supply chains change in future after the pandemic. And I mean, we discussed before that companies usually tend to, at least we saw in our samples, that companies usually tend to focus on extending payment terms towards the suppliers. And this might be maybe because it's easier to make demands on suppliers rather than on customers, perhaps to improve sales or stay competitive, as Henrik mentioned. And this has actually been a widespread common practice as well since the financial crisis in 2008. But what at least one of the things that pandemic showed is that focusing mostly or mainly at the supplier side might be very risky. Yeah, and I'm gonna maybe steal again what Henrik said about Asian companies, but we actually had customers as well in that were demanded prepayments during the pandemic in the past months rather than being offered the usual long payment terms from their Asian counterparties. So we see that, I mean, this pandemic has probably been a wake-up call on the risk of focusing on supply chain, or at least on supplier side in a working capital strategy. And I think that the challenge for companies after the crisis will be to make their supply chains more resilient, less risky, without weakening this competitiveness that I mentioned before. So the big question might be how to do so, and how to do so maybe with working capital strategy in mind. This pandemic has revealed the fragility on supply chains, and also the importance of knowing your suppliers, on having the full view on the supply chain. And we know that rarely companies think about their supply chain as going all the way back to raw materials. But we believe that they need now to include tier 2 and the suppliers of their suppliers in their analysis, to make sure that their major suppliers will be there after the rebound. And therefore, I think that the pandemic will then push companies to have even closer relationships with their suppliers, to work with their suppliers to ensure their financial performance, maybe of their suppliers, by either finding sustainable payment terms for them, or maybe even being involved in helping them to get finance for their receivables, or for their suppliers' receivables. And here enters the supply chain finance that we discussed before. So in terms of DPOs, it might depend on these strategies. It might depend if we want to find sustainable payment terms with the suppliers, or maybe help them getting finance and agree on different payment terms then as a consequence. But I'm pretty sure that there will be some sort of change there that companies must take into account.
Interesting. I mean, I think basically what we're saying there is that, you know, supply chain financing is still a very important tool, but it needs to be viewed in the context of the sort of longer term sustainable relationships with the suppliers and how we can work with them from both a working capital perspective, not just a short-term profitability perspective. I mean, just building on that point slightly, Vanessa, I mean, any thoughts around, as you said, I mean, diversification of supply base, what's going on there? Are companies looking to bring certain suppliers closer to home, have we noticed?
Yes, you're right. This is not a trend going on. Many companies are reconsidering and reshaping the geographies of their supply chains. This actually started before the pandemic, and the pandemic is probably only making sure that this will continue. And that's because actually other threats were identified even in the past years related to supply chains, as, I don't know, data privacy, cybersecurity, labor rights scandals. The US-China war last year motivated some companies to shift to a China +1 strategy, for example. So we are already seeing, and we saw already last year, things like dual sourcing or reshoring part of the historically outsourced functions of the company. And actually, it's interesting to see that even in the past few years, and then this year, we are seeing for the first time after 20 years, trade within regions growing faster than trade across regions. So trade within Europe is growing faster than trade within between Europe and Asia, for example. And of course, if we then think of the impact that these strategies have on working capital, we have to consider a few things. Also, in our previous reports, we saw that, for example, Asian companies tend to offer longer payment terms than the Western countries. So maybe moving supply chains from Asian to Europe, to the European region, then this might have an impact on the payment terms we can be demanded. Same goes for some other consideration like tax systems. Europe and the Nordic regions, they usually apply VAT rates of around 20 to 25% compared to, for example, 0 to 11% in the US. So that means that sales and procurement in Europe will give higher working capital figures than a US exposed business. So there are a few things that of course these strategies will bring to the working capital figures, and that must be considered.
Okay, thank you. Matthias, we mentioned DPOs and we've mentioned looking at supply chains, but you also hinted at the customer side of it as well, and thinking about DSOs and anything that can be done there from a working capital toolkit. What are your thoughts there, and specifically looking at, you know, cash and I guess overdues as well?
Yes, and as mentioned before, there is a tendency that companies, they look at the suppliers and ask for extended payment term there. Maybe it's easier. It's more difficult to ask your customer to pay faster because the customers are always right. But during the pandemic and as a consequence of this, many companies have been challenged on their liquidity, and especially the smaller ones. And therefore, it can be difficult, as we have discussed, to challenge your suppliers going on forward. So therefore, companies have to turn their focus to trade receivables in order to improve their working capital levels. And when you start to improve your handling of your trade receivables, you obtain some advantages. And the first one is the risk mitigation that you give. Because when you start to claim your payment faster, you can do that either through a more focused process regarding trade receivables or through a trade receivables financing program. But when you start to do that, you automatically decrease the outstanding amount you have towards a single region or towards a single customer or industry. And this can maybe also help you increase your sales, as you might have internal policies in your company in terms of what is the maximum credit exposure we can have towards single customer, region, industry, etc. So the risk mitigation is one thing. Another place to look is in terms of the overdue receivables. According to our study we did some months back called the overdue report, we saw that 23% of all the receivables in the Nordics are overdue. And this might be the easiest way to improve your DSO, as you might not feel you are being unfair towards your customer if you are tracing an overdue receivable rather than you were starting to asking for payment before due date. And what we suggest is of course to improve all the processes that are connected to overdue receivables, and that could be anything from not extending the process by sending non-mandatory reminders, or to trace your overdues faster, and to maybe most importantly just to be aware of the amount of overdue receivables and the risks connected to this. Because you also, besides the risk mitigation, you will also gain a cash release when you start to optimize your DSO, as you will have less cash tied up in outstanding receivables. And especially in a time with higher leverage, where there can be less cash available, you can use this cash that you obtain through an improved processes through trade receivables to support your strategic or financial targets. And that's really what we also would like to emphasize, that working capital management is more important now than ever.
Thank you. I think let's close this section in just a second. But Henrik, I just wanted really just to pick up one last point with you. Looking at risk really, and the result of the pandemic on working capital, has risk increased in the field of working capital as a result of COVID-19? And thinking about supply chains and the stress that's going on there, what's your views in that regard?
Yeah, in the report we have seen, and during the analyzing period, we have seen that there are higher risks all over the supply chain, and it has definitely increased during COVID-19. And I think both Vanessa and Mathias touched upon this. And of course, for companies, it has been a balance act between securing supply and sales, and at the same time manage the risk levels. The question has been a bit like it was during the financial crisis some 10 years ago. Who has the liquidity, and who can be a trusted partner going forward? And as we all know, a small snowball can quickly start rolling and increase. And as Mathias said, we also, while talking with clients, that they have a strong focus on risk, and they, of course, it's a risk and reward question. And we believe that this will remain going forward, because if the economy takes off, companies need to have liquidity, but they also need to have the funds in order to invest. And as Mathias mentioned, the leverage has increased on a lot of companies and industries. And I think it was very interesting what Vanessa put out there, talking about the DPOs and talking about smaller companies versus larger companies, strong companies versus weaker companies. Because we have a graph in the report that highlights the return levels for larger companies versus smaller companies. And what we have seen during these 4 studies that we have done in the past as well, and also in this one, is that smaller companies, they have a much lower return, and the return is actually decreasing for every time that we do this report. And these are publicly traded companies, and we think that the situation for private owned companies might be even more severe, because they do not have the possibilities to get bank financing or to get equity injection from their owners. So talking about this, being able to extend DPOs even further for companies, I think it's a crucial thing that we also start to think about the suppliers, because we need to pour down some liquidity for the suppliers. And what we have seen now is that many suppliers, they have had shortages of liquidity. And of course, for a larger company, not getting the supply is, of course, very crucial to get that. Going forward, I think the task will be to strive for a situation that benefits all parts, both suppliers and customers. And it's a discussion on who should, bear the working capital in the supply chain, and who should sort of finance it. And it doesn't always have to be the strong part that finance it, but it's very beneficial for the collective supply chain if the financing or the financing cost would be based on the risk on the strongest part in the supply chain. So that is sort of the long-term risk that I see, but also the opportunity, of course, that we somehow can, look at the collective supply chain and see how it can benefit all the companies that operate within the supply chain.
Okay. Good, thank you. Thank you all for your contributions there. We've got a couple of minutes left just for some questions. Thank you we've got 2 questions that have come in so far. If you do have anything, please just quickly drop it into the chat, which you should see on the GoToWebinar screen. We've got 4 minutes left. Mathias, I might just send this one straight to you. It's quite a specific question that's come in, and I'm just reading it here. It says, you've highlighted some of the key metrics that you've been examining. If I had to set working capital KPIs for my organization in 2021, what would you advise I start with?
Yes, thank you. A very interesting question, and it is often the thing that's very challenging is when you sit in an organization and you would like to optimize your working capital, and what do you have to look at? And the main thing to look at and what we also try to measure on is first of all the net working capital in relation to sales, and that's a very important KPI because it actually measures how much cash you have to put away when you sell for, let's say, €100, and if you have a net working capital to sales of 12%, you have to put away €12 just to finance your working capital. So that's one place to look at, but also the cash conversion cycle and your working capital days. So how efficient are you in getting your goods out and getting the payment, and when do you have to pay your supplier? Because it's really the gap between your collecting your payments from your customers and paying your suppliers that can be a challenge, and how do you finance this?
Okay, thank you. Mathias, another question just come in, and I'll send this one to you as well. I think the answer to most of this is actually in the report, but what companies were included in the study, what sizes and regions, etc.?
So we had 9,300 companies in the study, and it's all companies that are publicly traded, and we have actually companies from all parts of the world. So it's a global study. We haven't chosen not to include any regions, and what goes on in terms of the industries, I can't remember exactly how many, but that can be found in the report as well. But we had some broad industries. For example, we have utilities, and we had healthcare services. We of course had IT, and we have automobiles and real estate and so on.
Thanks. Okay, brilliant.
It's
Thank you.
20 industries covered.
20 industries.
Yeah.
Okay. Thanks. And then very quickly, last question that's come in, Henrik, maybe one for you. Just reading it here, has anything surprised you about the speed and rebound of companies in the Nordics? Are there any further concerns on the horizon as a result of the pandemic?
Yeah, I must say that I personally have been very sort of surprised of the rebound and how fast I would say the economy have picked up. And what I can see, what was the, sorry, can you repeat the question last?
Has anything surprised you about the speed, and are there any future further problems on the horizon as a result?
Yeah. Yeah, I would say it's what we have discussed about, how financially fit companies are and what they can do to sort of pick up the opportunities. And because sales, of course, requires working capital. And if you're not financially fit, how will you sort of manage to finance working capital going forward and sort of grab the opportunities ahead? And also investments. I think companies have been low on investments, and if you're a manufacturing company, you need to invest. You need capex to sort of, maintenance, and also about setting up factories and so forth. So I think one of the shadows going forward are actually how companies will manage to, grab the opportunities and what leverage they have today and how they will finance it going forward. Because they are not the same as before. Many companies are not the same as they were pre-corona. They have been hurt a bit, so that are the worries that I see going forward.
Thank you. Thank you very much. Okay, thank you to Vanessa, Mathias and Henrik for their contributions, and thank you all for joining us today. We will be making the report, as we said, it will be published today, both on Nordea Insights, but also we'll send you a copy direct to your inbox, so keep an eye out for that. And if you would like to discuss anything further, any specifics on what we've been talking about today, or you'd like a deeper dive, or you'd like to understand the implications of some of this on your organization or company, please get in touch. We've put Mathias's contact details on the slide, which should be in front of you now. Please get in touch with Mathias or any one of us, and we will be delighted to set up a session with you to talk through that. And finally, thank you for joining us. And we want to take this opportunity to wish you a happy holiday period and Merry Christmas. Thanks for joining us, and goodbye. Have a good day. Thank you.
Thank you. Bye.
Thank you.
Thank you.